This lesson builds on previous community association lessons about starting and running a community association. We will continue using acronyms and terms introduced in previous lessons. For example, GCA means the Georgia Condominium Act, and POAA refers to the Property Owner Association Act. If necessary, please refer to previous lesson notes for clarification. Let's start by talking about the financial side of running an HOA or POA organization. Properly handling money is an essential part of good governance. Boards manage association financial matters like any other business, tracking income receipts, revenue, and outgoing expenditures, expenses. The corporation must file federal, state, and local tax returns and issue 1099s and owner statements to people who will use those documents to file their own tax returns and claim refunds or make their liability. Even when an organization hires an outside accountant to prepare tax forms, the board, or an appointed office, assumes responsibility for ongoing record-keeping and cash management. Organizations typically use one of the following accounting methods. The cash accounting method, which records expenses and revenue on the date of occurrence. For example, if the board ordered new landscaping equipment and paid for the machinery on March 12, 2019, the records will reflect an expense entry on March 12, 2019. The accrual basis accounting method, which records transactions on the scheduled date of payment or income. For example, if an insurance policy payment is due on the 20th of May, but the check is not written until the 20th of June, the expense is still recorded in May as an accounts payable line item. The last method is the hybrid accounting method, which uses a combination of accrual basis and cash accounting methods. Most organizations use this method, although the IRS does not officially recognize the hybrid as an approved accounting method for tax reporting. Each community association sets their own financial statement policies. However, every HOA or POA issues periodic financial statements to owners and investors. Lenders, and some potential buyers, may also ask for financial statements prior to establishing creditworthiness. Examples of financial statements include the annual budget, income statement, profit and loss report, and the balance sheet. Income statements reflect the corporation's profitability for a given period, such as a month, individual quarter, or fiscal operating year. The balance sheet represents the assets, liabilities, and shareholder equity at a specific moment in time. The balance sheet may be generated at any time, as often as necessary, to monitor the current financial health of the organization or show the exact value of all assets wholly owned by the corporation. Budgeting is a very important job for the Chief Financial Officer and executive board members. A working budget informs spending decisions and helps the board set reasonable membership fees and one-time assessments for capital improvements or compliance penalties. Budgeting is the process of calculating expenditures and income for the entire year in advance. Board members review the prior year as a basis. Then, they predict increases in utility expense, decide whether major repairs are needed, such as new fencing, replacing the roof on common area buildings, or repairing sidewalks and parking areas, and try to estimate how many properties will be sold that may impact expenses and income during the 12-month period. The budget is a guide, and there are no legal requirements to prepare an annual budget beyond the GCA requirement to provide a budget in the full disclosure package during the first-time sale of each condominium unit. Many associations review the budget each month, and the board makes recommendations as warranted. Budgets increase and decrease based on reality. So if a natural disaster destroys or severely damages the community clubhouse, a budget adjustment allows financial leaders to revise the plan to allow new assessments to cover repair or replacement in the amount over any insurance payment received. There are many ways to structure a budget, including zero-based budgeting and incremental budgeting. A zero-based budgeting strategy means that no historical data is used as a basis, because each line item is thoroughly investigated and established based on projected necessity. An incremental budgeting plan uses historical data as a base, and each line item is increased incrementally. Budgets include both income and expense line items. Under the assets, you might find listings for general assessments, special assets, and specific fees and assessments representing income. The expense line items would include things like utility bills, property insurance, landscaping and pool supplies, common area plumbing repairs, paint, tools, office supplies, and other operating expenses. Capital reserves, deposits into a savings account for future capital improvements. Capital improvement expenses. Adding a gated entrance or pool is an example of capital improvement possibilities. Before we continue, here is a little more information for the non-accountants among us. Capital reserves are monies set aside for future improvements, where coming up with the money all at once would be financially challenging. By collecting special assessments for roof replacement based on life expectancy and depositing that money into a savings account, owners make a series of small payments over several years, and the association is prepared well in advance for large expenditures. While Georgia statutes do not require reserve funding for HOAs and POAs, FNMA and FHA require adequate reserve funds prior to funding condominium loans. Generally accepted accounting principles recommend all businesses regularly fund reserve accounts. Best practices for establishing reserve funding plans include determining the life expectancy of each capital asset, the cost of replacing each capital asset based on maximum life expectancy, and the total the corporation should set aside each year to satisfy future capital investment needs. Let's assume a new roof was installed over the community meeting center, and an association board is preparing the budget. With an expectancy of 10 years, barring some type of disaster, and a future cost of $20,000, the corporation would need to set aside $2,000 each year to cover a replacement. Of course, some roofs age prematurely, and replacement costs could unexpectedly rise if there is a wobble in the construction materials supply chain. So it is wise to shorten the savings period and slightly increase the minimum reserve to strengthen financial health and preparedness of the organization. Creating a budget is the board's responsibility. The budget approval process is clearly defined in the association bylaws and covenants, and almost always gives the owners the responsibility to approve or vote down the budget. Most bylaws require owners to approve a working budget before the board can act on it. However, if homeowners are satisfied with a proposed budget, they may not bother to show up for the special meeting to cast their vote. This could, in effect, put the board in a position to either take an action on an unapproved budget or forego certain projects because a new budget was not adopted. Boards can work with members to change bylaw phrasing to stipulate that proposed budgets are owner-approved unless voted down. This works much better than the previous situation, because we all know that everyone expresses dissatisfaction with an issue quicker than they would an outcome that makes them very unhappy. People show up to vote no. It's just human nature. A properly adopted budget reduces legal liability, ensures the board stays motivated to follow best practices, and keeps all stakeholders equally responsible for their shared property. Like budgets, most legal action taken by association boards is guided by specific covenant and bylaw language, even if there isn't a Georgia law or statute that requires or denies certain activities. For example, condominium owners in Georgia are required to pay assessments. Legal precedents in Georgia lawsuits support an association's right to assess liens and collect past due assessment based on provisions in bylaws and covenants. It is important to follow best practices when collecting past due fees and assessments. The acceptable path to winning a legal battle and ultimately receiving monies owed is: file a lien, start a lawsuit, send a FIFA notice to the default owner, initiate association foreclosure proceedings, find owner assessments eligible for lien attachment beyond community property. Other assets subject to a lien include real property, vehicles, watercraft, and anything that can be seized and sold to recover debt. When an association does these 5 things out of order, or in a manner not consistent with the community association bylaws, owners may countersue. Even if the owner loses their cases, it could cost the association thousands of dollars to defend their case in court. Boards have the responsibility to establish a comprehensive collections policy as quickly as possible after they assume management rights from the developer. The policy should be crafted based on current bylaws and covenants, or documents should be properly amended before the policy takes effect. This policy should include the date late fee. This could be something like 5 days after the assessment due date, or late fees will apply if not paid by the 5th of the month following the date of mailing the first notice. The amount of the late fee. This could be a fixed amount or a percentage. The amount of interest to be changed, if applicable. The date interest will be charged and the way it will be calculated. For example, simple interest, compounded daily or annually, etc. Date of acceleration. Due date of an assessment. Date notices will be sent to delinquency property owners. The threshold that will trigger hiring an attorney. The date attorney's fees will be charged. The GCA and POAA both stipulate that attorney fees are collectible, providing assessments and collection processes follow covenants and bylaws. Managing a condominium association is a complex process. When boards diligently strive to make sure policies accurately reflect covenants, bylaws, and Georgia law, they reduce legal liability and generally have higher owner compliance rates.